Hello everyone, welcome to the channel. This is Growing Wealth, and today we will be taking a look at another complete step-by-step options trading tutorial for the bull put spread. The bull put spread is also known as the credit put spread. It is known as the credit because you receive money or premium for executing this trade, and the trade involves the selling of put options. So when is the best time to use this strategy? Now, the bull put spread is a bullish strategy, so naturally you want the price of the stock to be on an uptrend. That is number one. Next, to have a higher probability of winning, we want to see the stocks bouncing off supports of trend line, and this gives us indication that a potential near-term bottom has been found. And lastly, this strategy is also suitable for trades that are trading in a narrow consolidation, when the range is so tight that there isn't much room for you to take a swing trade upwards. In that case, you can adopt a bull put spread instead. In other words, when you execute a bull put spread, what it means is that you have a neutral to cautiously bullish sentiment on the stock. You think that the price is likely to move and trade sideways in the near term. There's limited room for it to go up. In order to execute the trade, firstly, we want to sell a put to collect some premium. But remember that we never want to sell a naked put. So we have to buy back another put that is further out of the money, or in other words, a put with a lower strike to serve as a reinsurance for the put that we have sold. Each of these contract that we sell or buy over here is part of the trade and is also known as a leg of the trade. So therefore, it is important that both of these legs in the trade, they have the same expiry, and this constitutes the bull put spread. In order to profit from the bull put spread, there are a few ways. First, as long as price stays sideways. And you also get to keep the entire premium if the price goes up. As long as your sold put does not get into the money, you are safe and you get to keep 100% of the profit from the trade. So let us consider an example. This is the daily chart of the SPY, and from the chart, we see that the price has been in a very nice uptrend. Until recently, it corrects back down to the 50 moving average. And you think that the 50 moving average is a strong support. When you look back into the history of the chart, you see that past corrections corrects to the 40 EMA and also near to the 50 SMA. And then this correction, when it occurs, prices also started trading sideways for about a month afterwards. So you think that this scenario is likely going to happen again this time. So with that, it is going to be a good time for us to execute the bull put spread. But first of all, how are we going to execute this bull put spread? What strike are we going to consider? Let us take a look at that. As mentioned, this is the structure of the bull put spread. We will be selling a put and then we will buy an insurance further out of the money. And it is important that both legs have the same expiry. So first of all, what expiry should we consider? The most ideal case would be to sell a put with the 30 to 40 days to expiration. When you sell a put, you profit when the value or the premium of the put decays and expires over time. And the bulk of this decay occurs the fastest across this time span. That is why we want to target the 30 to 40 days expiration option chain. Next, to select which put that we want to sell, first, let's locate the strike with 0.25 delta. Afterwards, you should make sure that the corresponding strike price at 0.25 delta, or in other words 25 delta, it should be below as many supports as possible. And at minimum, there should at least be one support above it to protect and prevent prices from reaching our short strike with ease. Let's take a look at the option chain itself. I've already selected the expiry for you. We will be trading the 16 October 2020 expiration, and this has a 34 days to expiration. So expiry has already been settled. Can you identify which strike are we going to sell? Alright, so first of all, the bull put spread involves the put option, so we only want to focus on the puts, which is the right hand side of this option chain. Next, the delta column is over here, so you just have to go down this list to look for the delta of 0.25 or 25 deltas, and here it is, 0.25. And at 0.25 delta, the put option has a strike of 315. Alright, so determine short put, the first step has been done. Next, we want the strike price to be below some form of support. So let's take a look at the chart. 315 strike, where is it? On the chart, we can see the yellow line, which is the 100 SMA, hovering somewhere about 315.47. Therefore, between the prices and our short strike of 315, which would be somewhere around here. First, we have the 50 SMA, the blue line acting as the first line of defense or the first support. And next, we have the 100 SMA, which is the yellow line acting as our second line of defense or the second support. And by the time we reach the expiration of the trade, this 100 SMA would likely to have continued moving up higher, giving more room beneath the 100 SMA and our short strike itself. So therefore, criteria number 2 is also satisfied, and the 315 strike put option would be a suitable candidate for our bull put spread. So before we go on to select the strike for our further out of the money put, let us first determine the risk, because once you know the risk for your trade, it can serve as a mental shortcut for you to decide on your long leg. And for risk, normally we do not want our max loss for the trade to be more than 2% of our max capital or our account size. And therefore, with a capital of $10,000, your max loss for any trade should not exceed $200 per trade. But let's say we decide to be more conservative and we only want to risk 1% in this case. In other words, your max loss for any trade that you take should not exceed $100 per trade. Clear on the risk portion? Next, let us take a look at our long put. You can determine the long put in such a way. The difference in the strikes between your short and the long put multiplied by 100 shares, it should not exceed your max loss per trade. In other words, when you take your max loss per trade, which is $100, and you divide this by 100 shares, what you get is $1. And what this means is that your difference in strike between your short put, your leg number 1, and your long put, your leg number 2, should not exceed $1. And previously, since we shorted the 315 strike put, now our long put should have a strike of 314. Now, when you use this method, it is also important to note that the difference in strikes should not be too wide. Otherwise, you'll be losing out on some profits. We'll take a look at this in greater detail in the examples later. So remember your risk for the trade, and previously we have shorted the 315 strike boxed up in red. And we have also calculated the difference in strike to be $1. And therefore, we will be buying this 314 strike as a reinsurance for our bull put spread. To find out how much each of these contracts are going for in the market, you can check this column over here. So this column mark gives you the midpoint between your bid and the ask. And currently our 315 strike is selling for 451 and our 314 strike is selling for 342. In other words, this is what we will be doing. We will be selling one put option on the SPY expiring 16 October 2020 with a strike of 315. And for this, we collect a premium of $4.52. And then we move on to buy a reinsurance, the same put contract on SPY, with the same expiry date, but with a lower strike at 314. And for this, we pay out a premium of 433. So when you take 452 minus 433, what we have is a net of 19 cents. And this will be our profit for the trade. So these two legs together gives us our bull put spread, and it is annotated as such, 315/314. Premium collected we have already calculated to be 19 cents. Now when you enter the bull put spread, what it means is that when prices for the SPY stays above 315, you are safe, and you get to keep all the premium that you have collected. However, if SPY falls below 315, then you are obligated to buy 100 shares of SPY at 315. This is because you have sold a put option on SPY at 315 strike. Now if SPY falls lower to below 314, because you have bought a put option on the SPY at 314, now you have the right to sell away your 100 shares of SPY at 314. So can you see the whole picture? You buy 100 shares at 315 and then you sell 100 shares at 314 if the price of SPY crashes below 314. And what it means is that you will have suffered a loss of $1 per share, and multiplied by 100 shares, that is $100. Now let's not forget that you have the premium collected previously, so this will get to offset your max loss. Alright, and what I've just explained so far is your risk profile at expiration, and it looks like this. Your max loss is calculated by the difference in strike, which is 315 minus 314, and then minus your premium collected, which is 19 cents. So therefore, the max loss for this bull put spread turns out to be at $81, and this will occur if SPY stays at 314 or lower by the time of expiration, which is 16 October. Next, our break even for the trade is calculated by taking the short strike, which is 315, the strike that we sell the put at, minus by the premium collected, which is 19 cents. And when you do that, that will give you a break-even price of 314.18. And the max profit for this trade is rather straightforward. It is just basically whatever you have collected upfront when you executed the trade. And it will be 19 cents multiplied by 100 shares, which is $19. And this occurs when SPY stays at 315 or above by the time of expiration, which is 16 October. If everything is good, then we move on to the third step, which is risk management and position sizing. How many contracts are we going to trade, or how many contracts should you trade given your account size? We have already calculated our max profit to be $19 and max loss to be $81. So following our previous example, with a capital or account size of 10,000, risking 1% per trade, your max loss is only $100 per trade. Now, there are a few ways you can go about trading the strategy. The first one is to be conservative and the safest of all. When you adopt this behavior, you can follow this rule. The max loss for the trade should be less than 2% of your capital. And since we are only risking 1%, which is $100 per trade, this criteria is easily satisfied. And the max loss for the trade is at $81. Therefore, you can only take up one contract. Now, if you are a beginner and just starting out in options trading, then this should be the safest way for you to go about trading while accumulating some experience and also to gain some confidence in the markets. Now, if you are a more experienced trader seeking for higher risk and higher returns, then perhaps you can adopt this. Now, we are looking at 50% of the max loss for the trade is less than 2% of your capital. If you do this, then perhaps you could take up two contracts of the trade, right? If you take the max loss multiplied by 2, you'll be risking a maximum of $162 if this trade goes wrong. And at 50% max loss, it is just basically 162 divided by 2 and you are back with the original max loss, right? So there you go. And if you are seeking even higher risk, then perhaps you can do something like this. To have a 20% max loss for the trade to be less than 2% of your capital. If you do this, you'll be able to trade up to 6 contracts of this bull put spread example. With 6 contracts, our total risk will be 6 multiplied by 81, which gives you $486 as the total risk in this trade. And if we exit when our max loss reaches 20%, which is 486 divided by 5, the loss that you have incurred for the trade will be $97.20. Right, still lesser than the $100 per trade that we have limited yourself to. Alright, so I hope this gives you some sense of risk management and position sizing when doing the bull put spread. Next, what's important is that if you choose to adopt a higher risk, you have to make sure that the corresponding strikes for your max loss should be below some form of support on the chart. What do I mean by that? Let's go through some examples. Alright, so this is the daily chart for the SPY, and as you have seen, this is the correction that we have encountered on the chart previously in our example. In fact, prices have broke down a little bit and broke down below the 50 SMA already. But let's ignore that for a fact, and for practice sake, let's assume that we still think that prices is going to stay above the 50 SMA. And we go over to the option chain, we are going to trade the 23 October expiration with 32 days left to expiry. So once again, we are going to go through the usual practice, go over to puts, go over to delta and locate the 25 delta, which is somewhere in between here. So either one is fine. And let's say we trade the 310 strike, right? So we are going to sell the 310 strike. And then according to our 10,000 account example, what we are going to do is to buy back the 309 strike put as a reinsurance. So what I'm going to do is to hover around the 310 strike and I'm going to click on sell. And then I'm going to hover over to the 309 strike to the ask column and then hold on to my control key and click on buy. Alright, so once you have done that, your trade would have appeared under the order entry tools and everything will be calculated automatically for you. So we have -1, which means sell the 310 put, and then we have a +1, which means to buy the 309 put. And this is our bull put spread, right? Just slightly different from the example. And for this trade, we have a credit of 15 cents. Multiplied by 100 shares, that gives us $15. So before you go on to execute the trade, always right click and then click on Analyze Trade and look at your risk profile. So this is the risk profile of the trade that we are looking at right now. On the x-axis is the price, and on the y-axis is your profit and loss. Right, we have the zero mark over here, so anything above that is your profit, anything below is your loss. So focusing on the chart itself, you can see two lines. The line in red, this is your P&L at expiration, and we have gone through this in our tutorial earlier on. What is new is this purple line. So this is your P&L, profit and loss, on the day itself. And this day is stated in this info box over here. And then this date on top, we are just going to set it to our date of expiration for our trade, which is 23rd of October. All right, once you have done that, just go over to this drop box over here, set slices, break even, and set it to the expiration date. And if you mouse over to the extreme left on the chart, you can see that it displays negative $85, and this will be your max loss at expiration. So if you are trading with the conservative mindset, then there is nothing wrong with that. $85 is well below your allowed max risk per trade, which is $100. Now, the problem comes when we are taking on more risk and trading more contracts at one time. So let's say if we are now adopting the most aggressive risk, right? 20% max loss. In that case, we can take up to 6 contracts, right? So I'm just going to click on minus and then just continue adding more contracts to the trade. So at 6 contracts, what is our P&L looking like? We have our max profit to be $90 and our max loss to be at $510. So $510 is definitely way too much for your account to handle. Remember that our predetermined risk is only $100 per trade. So therefore, what you want to do if you adopt high risk is to look for the strike price at which you will lose $100. And as of the 21st of September, which is the day that we are going to enter the trade, you'll lose $100 if prices fell to maybe about 313. Right, so what we want to do next is to then go over to the chart and find out where 313 is. Is 313 below some form of support on the chart? So 313 would be somewhere around here. So is this a comfortable level for you to place your stop loss? In other words, is this level protected by supports? And will these supports prevent prices from hitting your stop loss at 313 very easily? First of all, we have the 321 horizontal support, which has been tested quite a few times recently. And next, we also have our 100 SMA. And this perhaps could have moved up to converge with the 321 level as time moved on with the trade, forming a strong support for prices to hit and bounce off before hitting our 313 level, right? You can think of 313 as a suitable level to place your stop, and in that sense, this trade would be suitable. And therefore, we can place this trade as this trade should be relatively safe from getting stopped out. A negative example would be to go through the same exercise and then you find the level at which you lose 20% max loss to be somewhere around here, right? And if it is as such, then this level is above all our current supports, that is between the price and your stop loss level. And therefore, there is no protecting prices from hitting this stop loss level with ease. And once prices hit this, it means that the max loss that you have allowed for a trade, it has been reached and you have to exit and get out of this trade. So if you come across such an example, then I would say that this trade would be rather risky and it is very easy for you to get stopped out. Alright, if you recall previously I said that the difference in our strike should not be too far away, right? So ideally we do not want the difference in the strikes to be greater than 5. Or in other words, you do not want the delta to differ too much, right? So ideally maybe a delta of 0.05. So now let's say we have a ultra big account and then we are able to risk $1,000 per trade, right? So this is our max loss per trade. And using our mental rule, you can very easily calculate that the difference in strike that we can trade would be $10. So are you going to sell the 310 strike, which has about 25 delta, and then you are going to buy the 300 strike? Going by the conservative way, which means to only trade one contract, this trade would have a max loss of $1,000 minus the credit that we receive, which is $1.26. Another alternative would be to sell the 310 strike and then buy the 305 strike. And since we are risking $1,000 per trade, we can double up the size that we are trading. So we can trade up to 2 contracts. All right, so let's right click and analyze these again, and then we'll compare afterwards. Another option would be to sell the 310 strike and then buy the 308 as a reinsurance, risking $200 per trade. And then since we can allow up to 1,000, we will trade 5 contracts of this. All right, so right click, analyze. Now, for each of the case here, we will have different profit and loss. The first example, when we sell the 310 and buy the 300, we get $1.26 credit. And for this contract, since our max loss per trade is $1,000, we can only do one contract. But if we sell the 310 and we buy the 305, we get 70 cents credit. And we can do up to two contracts and not exceed the max loss that we have. And I guess it is very straightforward that two contracts giving you 70 cents will net you a total of $1.40 in credit for the whole trade, which is more than the first example that we have at $1.26. Right, what about our last example? When we sell the 310 and we buy the 308, this will give us $200 of risk in the trade before considering the premium. And for this, we can take up to 5 contracts. And if you take a look at this trade, these are our P&L. We will have $145 in max profit and max loss to be at $855. Still better than our second case by just a mere $5. But don't forget that as you trade more contracts, the commission incurred will be higher too. So therefore, in our example that we have just considered, the second option would be the best, yielding the most profit with the same level of risk as opposed to our first and our third example. Alright, so these are just some additional things that you have to consider when selecting your strikes, in addition to the set of rules that we have laid out earlier on. Alright, so I hope you have a better picture and understanding of risk management and position sizing for the bull put spread. So in summary, what we want to do is to sell a put option with a 25 delta and then ensure that the strike price for the option is behind some form of support. And then next, we determine our shares, our risk per trade, and from here, we can very easily determine our long strike. And recall that the difference in the strike should not be too wide. If not, you will lose out in some profits. And lastly, always analyze your risk profile, just like I've gone through with you. Look at your max loss, your max profit, and then if you're going for higher risk, look for the level at which you will be stopped out and make sure that that level is behind some form of support in the charts. The bull put spread strategy does not stop here. We will still have more coming up. And next, we will be taking a look at how to take profits and also more optimization of the strategy itself. And that includes things like, should we really sell the 25 delta? And should we consider further expiration dates? And then we'll also be taking an in-depth look at trade management. What to do when prices are about to hit your short strike and we are in a losing position. How can we manage and repair the trade such that we do not suffer that much of a loss? And lastly, we'll be comparing between the bull put and the bull call spread, the pros and cons of each strategy, and when to use which of these strategy. I hope this tutorial video has given you a clear picture of how the strategy works and boosted your confidence in placing the trade yourself. Show your support by smashing the like button and subscribing to the channel if you are new. I also like to welcome you to join our Growing Wealth community chat for further discussion and sharing of trade and investment ideas. Thank you so much for watching. I'll see you in part 2 of the bull put spread strategy tutorial.